on here. All right, I think we're in good shape. Well, guys, thank you so much for inviting me here this morning. If it's okay with you guys, I'll maybe go through about a half hour of just prepared remarks, and then maybe take questions for 10 or 15 minutes. And Michelle Rubish said, you know, this is a great turnout. We have all the old timers here, and so I was wondering what that said about me, because I have to tell you, I feel a little bit like an old timer now, because I've been candidly too cautious on the market, and so I feel like I remember this book, The Money Game, and at a certain point, one of the portfolio managers said, you know, we have to hire kids. We have to start hiring kids right out of college, because I'm just, you know, I'm getting too cautious. I'm getting too old. We have to hire a kid that doesn't, you know, hasn't been burned by airline stocks and, you know, all the rest of it. So, and I'm starting to feel a little bit like that. But I know Lou Lundquist is here, so it's an honor to see you, sir. And again, it's good to be here. I have a good relationship with the Seattle Society for a long time. I want to introduce my colleague Chris Garland here, who's manning the Mac there. So we have this handout. So if you know, all these things are available to you if you're interested. If you want to give your business card to Chris, if you want to get some of the charts or data or anything along those lines, talk to Chris after the presentation. Well, you know, I think. Mark Twain, I think, once said, you know, it's not the stuff you know for sure that gets you into trouble. It's not the stuff you don't know that gets you into trouble. It's the stuff you know for sure that just ain't so. And I think last year, the thing that I knew for sure, or we were pretty good at, was earnings. Earnings were up about 3%, the S&P 500, you know, just kind of eyeballing the fourth quarter. But in calendar year 2012, S&P 500 operating earnings looked like they were up about 3, and yet the price return of the market was up 13.5, and the total return was up 16. And it just, you know, it speaks to the broader idea. And I'd be very honest, if you had given me all the newspapers last year without the prices, and you said, you know, would you get multiple expansion out of the fact pattern last year? I don't know if I really would have gotten. I don't know if I still would have gotten the right answer. And so there's a little bit of a reevaluation on our part at our company about, and this always gets me into trouble, whether the fundamentals really matter all that much if the Fed is going to continue to keep interest rates exceptionally low for a long period of time. And as we'll get into, I really take the Fed at its word on that. So that's really kind of what I'm struggling with. I think earnings are, you know, a little top-ish here. I think, you know, margins could come in, but by the same token, I think that financial repression is probably the single most important concept in finance. So if you guys look through this handout, I'll go through some of the weaker points first, and then I'll get, you know, more optimistic as we go along. But just to kind of get the bad stuff out of the way first, if you look on page 3, this is kind of what we're talking about. This is earnings and revenues from 2009 to today over the last 4 years. And you can see that total operating earnings are up about 100% on sales increase of only 3%. And ex financials, it's a little bit better. Financials are a big part of this, but you're up 26 versus 4. And so the broader point is that margins have done all the heavy lifting. And if you look at the bottom of the page, page 3, nominal GDP is still probably growing at around 4%. And in the first quarter or two of this year, 2013, as for reasons I'm going to get into, mainly fiscal drag, I think there's a possibility that nominal GDP growth is running slower than 4, you know, something like 3. And so this is, I think, a little bit of the challenge in terms of earnings that you're going to have this year. We're still using, and I talked to Nick Bonsack, who does these numbers for us, we're still using $96 for S&P 500 operating earnings for this year, and the consensus is somewhere around 112. And I do think, given where margins are, it's very, very hard to come up with 112. So that is something that could be a little bit of a headwind, especially, I think, for consumer discretionary. That sector in particular has moved up a lot, and I think one of the headwinds you're going to see, especially in the first quarter or two, is the payroll tax starting to take a bite out of consumer spending. Good news is that housing seems to be getting better, the employment picture seems to be getting better, but there might be a little sticker shock in terms of the first paychecks here in January. If we go a couple of pages just to talk about, the things that mattered a lot that don't seem to matter all that much anymore. If you go to page 8, I'm going to talk about, and we have a policy shop, talk about Washington, and of course that cast a very, very long shadow over the financial markets last year, to put it mildly. And now I get the sense when I've been out on the road all January, I get the sense that there's a fair amount of policy fatigue. People have just had enough. They said, the election's over, and I'm conservative, so I'm not only am I sick of it, we lost, so I'm all bummed out, and all that stuff. And I get the sense a lot of investors just saying, listen, I just have to go for growth. I just have to. I can't worry about this kabuki dance that's going on in Washington. I have to figure something out. One of the things I should have said on the prior slide is that low nominal GDP, I think, probably argues strongly for the idea that large caps are going to continue to outperform, in my view, mainly because it's going to be hard to get market share is hard to grow organically. It's something that has to be taken from somebody else. And I think the fiscal drag this year is something that's going to make it maybe even harder to grow the pie organically. You're going to have to essentially take market share. Just to give you the round numbers, and of course this is still a work in progress. A payroll tax is probably going to take about $120 billion out of the economy this year. Fiscal drag of $120 billion. The higher taxes on the upper income folks, probably another $50 billion. So you're about $170 billion of fiscal drag right off the bat. It's about 1% nominal of GDP. And then, of course, we've got the debt ceiling and the sequester to go through. And as you might have seen, the debt ceiling has been kicked into May, mainly because the Republicans were getting their butts kicked on the issue, and they just punted. And now the big thing to worry about, if anyone's going to worry about it, is the sequestering of defense and healthcare spending on March 1st. And I think by all indications, I would say the Republicans are not going to roll on that. I don't think. So that's something that could provide the basis for an uncomfortable couple of weeks or months in March and April, just as people work through, or as Congress works through what the cuts to spending actually will be. I don't know if they're going to leave them in defense and healthcare. They might have them in other parts of the budget, but in my view, this is another something else to keep in mind. I was in London last week. If you go to page 10, I would say going to the good thing about Europe, I guess, is that it makes you feel better about being American, I think. I mean, I love Europe. I love hanging out there, but I spent a lot of time in Italy and all the rest of it, but it's a great place to visit. But I don't know if I want to start my business there. But one of the things that I think is going to be another kind of straw in the wind, or something else that's a little worrisome, is I do think Europe is likely to get, as a whole, is likely to get worse this year. And the reason why I believe that is mainly that the currency has strengthened meaningfully since Draghi made his "trust me, it'll be enough" speech in July. So you have a situation where there's nothing I would argue is pro-growth that's going on in Europe. So if you take like Hollande, Francois Hollande in France, and you say his pro-growth strategy is to raise the top marginal tax rate to 75%, to reduce the retirement age from 62 to 60, and to hire 100,000 more public sector workers, right? And then you have people that are saying that I want to become Russian. You have like Gerard Depardieu saying, I don't want my French citizenship, which I would say if you're running a country is bad. That's a bad sign. People are giving up your citizenship to become a Russian citizen. So, but in any event, this is something where this speaks to one of the themes we have this year is this idea of beggar thy neighbor currency policies. And what's happening in Europe, I think, is it speaks to the idea that it's very hard to weaken your currency if everyone's doing it at the same time. right? And that is one of the things that I think is a big theme for this year, is that you see in the Bank of Japan, they haven't done a lot yet, but they're talking a big game about trying to weaken their currency. Swiss National Bank has increased the size of its balance sheet dramatically. Bank of England, same thing, Fed, all the rest of it. So this is, I think, one thing to keep in mind this year. And then maybe the last thing, and this will end the bad news part, the things that are headwinds for the economy, is on page 12. And I still think money matters. When I came into the business, people spent a lot of time on the money numbers, and it had a big impact on the financial markets. And now, I don't know if anyone really pays any attention to it anymore, but I still pay attention to it because I think ultimately financial assets are driven by liquidity, broadly based. One of the things that's interesting, and it speaks to the idea of the limits of monetary policy, is that the Fed has thrown money out of helicopters, almost literally. I mean, just shy of almost literally doing it. You've had all this increase in bank reserves, all this money go, but it's gone directly into bank vaults. The velocity of money continues to go down. So despite all this excess reserves, in a free society, it's hard to force banks to actually make loans, hard to force people to take on loans. And I think part of the reason why that's been happening is partly a regulatory issue. I mean, I do think if you look at Dodd-Frank, as a result of Dodd-Frank, 398 rules will have to be written as a result of the statute, and so far only 136 have been completed. So if you're running a bank, you're running a financial institution, you've got 260 to go, and it's not as surprising in a way that if you're a bank, you're paying close to zero on deposits and just playing the yield curve. You're not getting really sparky about increasing your loan portfolio and all the rest of it. Now, that may change, later on this year. The more progress we make on this, the more the rules are established, the more people can move on. But this is something else that I think, it argues for the fact that in some ways you haven't seen anything yet in terms of the potential impact of money and monetary policy on the overall economy. In terms of the good news stuff, if you go to page 13, there's no question, I think, that housing is improving. I do think that the improvement in housing is in its infancy, and I think it's one of the reasons why I think you have to take, and we're going to talk about this, take the Fed at its word that it's going to keep interest rates low for a long period of time. Because anytime you see any sort of backup in interest rates, you'll see the Fed kind of sit on the market, sit on 10-year Treasury yields. And again, it's because this is in the early innings of housing improvement. One of the things that would be, and you can get into a virtuous circle here, hopefully, one of the things that you want to start seeing is more household formation, because number of homes obviously skyrocketed in the late 90s, early part of the last decade. But you have what I think Bloomer calls them the boomerang kids, right? You throw them off to college, and then they wind up back, on your basement couch or something. And so it's hard for people to get jobs. It's hard for them to start families, all the rest of it. So it's one of the reasons why you've seen this, the housing market have so much of a hard time. But little by little, we're making some progress there. If you go to 15 and 16, or 15, I do think, there's when you get yourself into big fiscal troubles as a country, there's usually about 4 ways you get out of it. There's inflation, there's deflation, there's conflict, and then there's growth. Okay, and politicians generally find it easiest to go for inflation. And then at a different era, probably up until 1945, we probably would have taken over Mexico by this point, or we'd done something, or but it's kind of politically incorrect now. But the U.S. I think has a shot at actually growing itself out of its problems. It's, despite all of its best efforts to screw everything up in terms of entitlement spending and overspending and all the rest of it. Ironically, the U.S. almost by providence, could get out of this, partly because it's sitting on so much natural resources. And so this is just a simple chart. Natural gas in the U.S. less than 4. Liquefied natural gas is 15 in Japan. It costs about $4 to turn natural gas into LNG and ship it to Japan, so that's a huge margin. And one would think that over time that can't persist, that the market should take care of that. Of course, this is a long-tailed thing, but the one thing that you're starting to see now, which I think is very positive, which could last for a while, again, is in its infancy, is the idea of onshoring. Is that there are a number of manufacturing companies now that are starting to see the overall cost structure of the U.S. be much more attractive for manufacturing. And again, it's not going to be everything. You're not going to get all the jobs back. But I look at Dow Chemical as just one example where they said they would never put another plant in the U.S. ever again. And they broke ground on one in Texas last April. And so I have a feeling you'll see more and more of that. It won't probably be too long before you see the entire transportation grid, probably in the next 5 years or something, being run on natural gas. So very, very positive from a cost and profit perspective longer term. If you go to the next page, I would, as an American, I think that it's just what we need. U.S. economy right now is about 85% services, 15% manufacturing. And if you also look at just the composition of GDP, about 71% of it still is consumer spending, right? So still very geared towards consumer spending, and also I'd say government spending is another 22, 23, 24% federal, right? So doesn't leave a lot of room for I and X, to put it mildly, right? And we're running a trade deficit right now. My view is that this is obviously unsustainable. If the U.S. wants to grow, it has to rely more on capital spending and exports, kind of the way it used to do it. And also say there's very positive things that would happen for the country because, and it's hard for you guys here to see this, but this is an unemployment rate by educational level. And what it shows you is that if you have a college degree, the unemployment rate is 4. If you'd have less than high school, your unemployment rate is about 12. And one of the problems with having a very service-oriented economy is that if you don't go to college, it's very hard to make a good enough living to have a family. And so getting more manufacturing, higher value-added manufacturing would be very good, I think, for the social fabric of the country. And again, we have an opportunity here in the U.S. to do it, an opportunity that I would say other developed countries don't have or are unwilling to use. France, again, to pick on France, has a lot of shale. Never going to use it. U.S. has much better demographics, right? We have a younger, it's aging, but we have a younger society. We're pretty open to immigration. So those things are very, positive from a long-term growth perspective. And then probably the biggest, we go to 19, Chris, the strongest reason probably to be bullish, at least for the next year or two, at least I would say at least 2 years, is the concept of financial repression. And it might render all the other stuff I just said meaningless, candidly. And financial repression is a term that was coined by Carmen Reinhart Rogoff. And it's essentially an artificial way of creating inflation because what you do is you manipulate the Treasury yields to be negative in real terms. So coming out of the war, World War II, we actually had explicit interest rate caps on Treasury debt, and they were lower than the rate of inflation. Right now, we don't have explicit interest rate caps, but you have the Fed that last year the Fed bought 77% of the net new issuance of Treasuries. Okay? And I would argue here that the Fed almost can't step away from their bond buying program because of the way our debt is funded. It's kind of a Bear Stearns method of funding yourself. We have massive long-term liabilities, and we're funding ourselves short. 60% of U.S. Treasury debt matures in the next 3 years, and the weighted average cost of the debt is 2%. So said another way, if the Fed steps away from the market and interest rates back up, it blows a hole wide open in the budget, just on interest expense alone. So I think you have to take the Fed at its word that it's going to keep interest rates low for a long time. I'm not advocating this as a good policy necessarily, but I mean, I think it's the world that we live in. And I think as I mentioned before, I think what you're seeing now is that, at least globally, you're seeing, kind of son of Bernanke all over the place. Draghi is kind of on the same page in terms of deflation is verboten. I'm going to take my chances with inflation. Carney now in the UK, very similar, very simpatico with that idea. And so this is not just something that's going to, I think, happen in the US, something that's going to happen globally. But so you have to look through things through the prism of the idea that you're going to get negative real interest rates on treasuries for the next couple of years. And if you go to the next page, and we were just talking, Wally and I were just talking at the table here, I mean, I know there's been some talk in the last couple of weeks about the great rotation in the equities from fixed income. And the one thing I feel most strongly about, or the one thing I have empirical evidence to support, is that if that's happening, it's in the top of the first inning, that it's in the very, very early stages of happening. Because if you look at anecdotally what pensions and endowments are doing, and if you look at empirically what individual investors are doing, there is very little evidence that that shift started to happen in 2012. It may be starting to happen now, but usually these things don't last a couple of weeks. These are, this shows you fiduciaries. This is unfortunately the best data we can really get in aggregate. But you can see there's a fair amount of a love affair with alternatives, fixed income. You can use Cal Sturz just as a simple example. We can use Cal Sturz in Harvard. Cal Sturz, I think, has an actuarial assumption of 7.5%, and they have 25% in equities, and 40-50% in alternatives, maybe another 25% in fixed income. Harvard has 11% of their endowment in domestic public equities. Yale is something like 6%. So, it really kind of begs the question, if you're going to get negative real interest rates from treasuries for a long period of time, how on earth do you get 7.5%, or how on earth do you generate the returns that you need? Now, the argument that comes back to me is, well, we might not have public equities, but we have equity. We have private equity. We have other things that could, scratch that itch. And I'd say, that's fair, except that there is a liquidity difference between public and private equity. And Harvard, I don't remind them of this, but I do remember when Harvard had to go out and borrow against the value of its endowment 4 years ago. It was so loaded with alternatives that it had to go hat in hand to, which almost gets into malpractice, I think, of running a $25 billion endowment. I mean, that's really not what it's there for, I don't think. But in any event, there's a long-winded way of saying I think endowments, pensions, and fiduciaries they're at the initial stages. There's very little evidence to suggest they're doing, much of this yet. If you go to the next page, we know that the individual investor, and this is through November of last year, it's over the last 7 years. But even if you looked at just on a discrete 2012 basis, obviously the magnitude would be different, but the shape would look the same. There was a big love affair with fixed income, still a big love affair with fixed income, and people wanted nothing to do with equities, right? And I think it was partly because of Facebook and Bernie Madoff and all these other people saying, it's rigged. But we'll see. I know in the first couple of weeks of January, there's been some evidence that people are starting to switch money from fixed income into stocks. We'll see what kind of legs it has, but I think maybe people are coming to the conclusion that they're going to get hurt potentially. I hope so, because I do think they're going to get hurt with this asset allocation that they've got. The increase in bond market sales, bond market mutual fund sales, is about proportional to the decline you've seen in money market fund sales, or the redemptions of money market funds. So there's some, you could say circumstantial evidence to say that people were buying bond funds as a proxy for cash, right? They're saying, I can't handle getting zero anymore, so I'm going to buy something that has no risk. I'm going to buy the PIMCO Total Return Fund or something. And, again, it's worked out. I mean, but I'm not sure people really understand the duration risk that they're I don't want to be presumptuous, but I'm convinced that most people don't understand how much money you can lose, how quickly in bonds. And I think the irony about the fiduciaries and the individual investors, in many ways, they're, Charlie Ellison called it playing the loser's game. You know, you're basically playing not to lose. You're playing the game essentially to limit volatility in the returns. But what appears to be less risky, in my view, is an extraordinarily risky strategy. You know, ultimately, especially if you wind up getting inflation out of these policies, which I think is inevitable. I just don't know. You know, as it says in the good book, I don't know the time or the hour. But I do know if the Fed increases its balance sheet and the Treasury is running budget deficits year after year, the other countries are doing the same thing. Nothing good happens from that. But for now, this seems to be where we are. If you go to page 22, this is, I only have a couple more pages here. But if you look at page 22, this is the equity risk premium. It's earnings yield minus the 10-year Treasury yield. And you can see it's about as wide as it's been since 74 bear market. And now, the 74 bear market, you know, this happened in 74 because stocks went down by 50% over an 18-month period. Here, it's happening because the Fed's sitting on interest rates. And so one of the pushbacks I get on those people say, well, you know, you're comparing equities to a manipulated market. It's not fair. It doesn't mean that equities are that cheap. I'd say, well, maybe not historically, but it's all relative. And on a relative basis, they are as cheap. And if you think the Fed is going to be manipulating the market for a long period of time, as I do, it may be a distinction without a difference. So, I'm kind of, I think, I don't know whether it goes back to a normal level of equity risk premium, but I mean, it wouldn't be surprising to me if the equity risk premium came down some, given people's confidence, perhaps, in the Fed to keep interest rates low. If we go to 24, this is a chart from the San Francisco Fed of the PE ratio of the S&P 500, and this is their definition, by the way, so don't get mad at me, but the middle to old age ratio, right? And they're saying middle age is 40 to 49, and old age is 60 to 69. And it seems harsh, but I don't know. That's what they came up with. And so, you know, that's more mature and less mature. I don't know. But you can see there's a pretty strong correlation here. And that this is one of the things you'd say that, you know, generally speaking, as the population gets older, there's going to be less of an interest in equities and more of an interest in fixed income. The thing that's interesting to me is that is this part of the chart, which is the 50s, was another period where you were aging a little bit, not a whole lot, but multiples went straight up. And I would say part of the reason why that is another period of financial repression. Right? As I said before, you just did it differently. Now you're doing it, but the Fed's doing it. Back then you had legislative action to limit what the Treasury could pay on their debt. So in another realm of financial repression where you're manipulating the interest rates to be negative. So there is a sense in which the longer-term trend might be somewhat lower because of the aging population if you get inflation, but in the short term you could have cyclical multiple expansion simply because, again, you're fixing the interest rate. And then the last thing I'll show you guys is really on page 33. And so I'm sure some of you are saying, well, what do I buy? And this is a screen that we came up with after the U.S. debt was downgraded. I would say the last time or the first time. Probably not the first time, I don't think. But right after the debt was downgraded in August of 2011, we counted 55 companies that had credit default swap spreads that were lower than that of the U.S. government, if you can believe it. So there were 55 companies where the market was saying, these guys are better credit risk than Uncle Sam. And right now, there's about 23 companies on this list. I think everybody up to Dominion Resources have better CDS. And in many instances, you can see here, they have dividend yields that are far in excess of 10-year and 30-year treasuries. And they have payout ratios that aren't all that high in some instances, right? So there's room to even increase dividends. So my view is that this will be the source of almost a new Nifty 50. That if you are in this initial innings of a movement away from fixed income towards equities, that this will be the first stop for a lot of people. Which is to say, the first stop isn't going to be something with 5 or 6 letters in the symbol. That'll come later on, like in December or something. But the first stop will be, something that stocks that look like bonds or have balance sheets that used to look like sovereign bond balance sheets look like, that type of thing. And so it outperformed last year. It's a little bit of a risk, I would say at the margins, a risk-off strategy, but I think it's kind of satisfies both itches, itches to be involved in the stock market, but you don't want to get too, you don't want to go overboard. So anyway, guys, let me stop there. That's 31 minutes, I think, on the nose here, and happy to take any questions you might have. Comments? Yes, sir.
Well, I'm curious, going back to your earlier part of your presentation, what do you see increasing the money velocity and approximately when?
Yeah. I think that the fact that net interest margins, and I don't have a chart of this in here, but there's a pretty strong relationship, as you might suspect, between book value and net interest margin. And net interest margin, I think, is getting squeezed. And I think sooner or later, banks, I think the bulk of the move happened last year without them having to increase their loan portfolios. I think you are at a point now where they're going to have to, that game is largely picked over. It's going to be hard to get interest rates a lot higher, or the curve to steepen a lot here. So I guess I'm just making a bet that banks are going to be more risk-taking and are going to start to increase loans simply in an effort to increase profits. But it's very much on the come. There's not a lot of evidence, candidly, that that's happening yet. Lending standards are still pretty tight, and but we'll see.
The slide, I thought it was interesting, the slide you showed on the asset allocation for endowments.
Yeah.
What did you say the equity breakout was?
Well, and you can see this is from the Common Fund, and I'll just to read these because I know it's hard to see. I apologize, but equities, it's down 2011. Equities 33%, fixed income 10, alternatives 53, and cash is about 4. All right, so again, it's kind of the Yale model, right? Which is to say, you have all sorts of private equity, hedge funds, other alternative assets, hard assets, all the rest of it.
And what was the breakout between public and private?
Well, so you'd say public is about a third, and then private, it's the bulk of the alternatives, I would say, would be in long-short hedge funds, so you'd have to, I don't know what percentage that would be, and then you have public equities, which would probably make up a lot of the rest of it. So it's still, very geared towards the alternative side. And you're trying to figure out why people are doing this, or, candidly, and I don't want to cast aspersions on the, because I understand their safety in numbers, and the consultants are telling them to do this. But I also think the opacity of the products, candidly, is an attraction for, which is to say, public equity is pretty demanding mistress. 9:30 to 4 every day. There's a price, which is, whereas private equity and some of these other things, you can kind of make it up as you go. Say, well, that looks about right. That type of thing. So, I don't know, but yes, ma'am.
Does this take into account funds that might be using futures to overlay equity exposure? So they might be having a little more exposure to the S&P through futures?
Probably, well, it would. That would probably be captured in the alternative. And I think, one of the things people would say would be, well, listen, I'm long-short equities, so, I have levered, I have a levered position in the equity market if the market were ever to take off. The only problem with that, I think, is that at least the last couple of years, the hedge fund performance has been pretty underwhelming, right? So 2 years ago, I think, the average hedge fund lost about 4.5%. Last year, the average hedge fund was up about 5%. And if this is the real thing in terms of a bull move, hedge funds almost by definition should underperform. I mean, right. I mean, so long equities are going to be the place to be. In terms of thinking about what could get endowments and pensions to make this move, one of the theories I heard yesterday is would be that if you had another good year in the stock market this year, that at the end of 2013, you'd have a situation where long only looks better than alternatives on both a 3-year and a 5-year basis. Right now, it just looks good on a 3-year basis. But on a 5-year basis, alternatives still look very good because you're including 2008. Right, so, but at the end of this year, it may not look quite as compelling. But yes, sir.
You suggested that inflation is inevitable, just the question is timing. And that's certainly understandable given the unwillingness of the President of the Senate to even contemplate attacking the primary problem, which is the land
Entitlements, yeah.
argues for a hard asset allocation. How would you do that allocation, and how would you play the hard asset idea?
Listen, I think it's a great question. I mean, I'm not going to answer it perfectly or well, but I do think. Let me say that one thing I do think for both individuals and institutional investors. I know this is a dirty word at a CFA luncheon, but gold or precious metals, I think I just view it as insurance. I know it has no. I mean, you go to most CFAs, you talk about gold, people are like, get out of here. It's got no, it costs you money to. I know all the. It costs you money to store it, and it's no yield, and all the rest of it. But there are times when it works, right? It works in times of deep deflation and intense inflation. And again, I know I'm not going to get the timing right, but my view is that wouldn't be a bad way to play it. I also think, I know it's moved a fair amount, but commercial real estate might be another interesting way of playing the real asset side. And then equities, will be a poor stand-in for those other two, but will obviously give you something in return, right? So it'll be a much better relative performer than fixed income, but it won't be as good as kind of the really hard assets. But at least you get some of the inflation back through pricing power. So those are kind of the main ways I've thought about it. But again, I still think the Fed. I think there's a lot of people that think the Fed is on kind of tenterhooks, just waiting to tighten at a moment's notice. And the one thing I'm saying is I think you have to take Bernanke at his word. I mean, I think the guy has been nothing if not completely transparent about what he wants to do. And I think the Fed's an awful long way away from tightening meaningfully. So it seems to me almost inevitable, as I said, that you're going to get some sort of inflation in this. And I think that's kind of what he wants. It might. I don't know what the right number is, but I don't think it's 2. I think he wants it more like 3 or 4. Yes, Miss.
I couldn't for sure read the chart from back here.
Yeah, no, I'm sorry.
But on the ones with the equity volume versus fixed income volume, and if individuals are moving into stocks or not, did that include ETF trading? Or is that mutual funds?
No, this is just mutual funds, but it doesn't change. It doesn't change. It doesn't change the picture meaningfully. I mean, it's a little bit better, but not really. The other thing I would say about ETFs, it's interesting development, is that they've really turned out to be institutional products. The theory was that they were really going to be things that really competed with mutual funds in terms of retail investors, all the rest of it. There's not a lot of evidence to suggest that. ETFs, by most standards, by most accounts, probably is about 40 to 50% of the average daily trading volume in the stock market these days. And I will say in our company, I'm amazed at how many hedge funds just trade ETFs all day long. I mean, we don't stand in front of the order, of course, but you kind of wonder, for 1 in 20, you should be buying alpha, I think, and you're really buying beta. I mean, a lot of instances, and so. Yes, sir.
You had a slide on Europe, and your macro outlook there is for it to get worse before it gets better. What does that mean for European equities? I mean, has that already been priced in, especially the large cap?
I don't. I would be very careful on European equities now. I mean, they moved a lot more than U.S. equities last year, and on I think weaker prospects for growth. And they were cheaper to begin with, so I understand that they're trading at single-digit multiples. But I'd rather take my chances on U.S. If you're going to go the equity route, I would much rather take my chances in the U.S., where they're at least I guess little by little addressing some of the problems that have better prospects for growth. But they moved an awful lot last year. Yes, sir.
You alluded to the idea that the piper will have to be paid someday for our disconcerting fiscal
Yeah.
management. The idea that I always have a hard time getting my head around is people on the other side who say, well, yeah, but everyone's doing it, and currencies are all relative, and interest rates are relative, and so as long as we're not behaving as badly as everyone else, don't worry about it. What do you say to that?
Well, I'd say that it's a very dangerous. It's just a very dangerous game that you're playing, right? I mean, they're probably right. I would say that's clearly the game the Treasury's playing, right? I mean, the Treasury Department should be taking this opportunity to issue 50-year or 100-year bonds, or right? I mean, because you have interest rates that are exceptionally low. There's an enormous zeal for yield, and yet we're funding everything out 3 months and 6 months. And I have to say, my talks with some of the people at Treasury don't suggest to me that there's like a grand plan. That I think this is just expedient, which is to say that it keeps the deficit lower now, and we can get away with it. But I would say that I'm not doing a good job of answering your question. I would say there's really been no country that's been able to really get away with that. History is replete with countries that have tried to debase their currencies out of fiscal problems, and ultimately it doesn't work. It can work for a while, but ultimately the cost of capital goes meaningfully higher. Yes, ma'am.
Your thoughts on Japanese equities and the yen?
That's a tough. That is a real toughie. I would say the reason why it's tough is that I've seen this so many times before. Since I've been in the business, I've seen it pretty much the entire time I've been in the business. This idea that, and I do think that there's been. 2 months ago, I saw one of our clients, and she said, I'm not buying it this time. It's a value trap. I've gone down this road before. And then I talked to her last week, and she's like, it's love. They're really going to do it this time. He's going to mend his ways and all this other stuff. I guess I'm skeptical, mainly because I don't think, at least thus far, there's been no concrete evidence or no concrete moves to really weaken the currency, and the Bank of Japan is still a stumbling block. Bad demographics, bad fiscal policies. Again, I'd rather, we may be getting there, but we're at least earlier in the process in the U.S. I'll take, yeah.
Fourth time's a charm.
Yeah.
You had a chart on the equity risk premium of earnings yield versus the
Right.
10-year Treasury. You see others look at the market based on current PE or even P versus future estimates. Some people do the Shiller approach with smooth
Yeah.
earnings. Are there any measures you think that stand out as a better signal of market valuation? And are there any of those that get mentioned often that you think are not good signals or irrelevant?
Well, listen, it's a good question, and I will say, just being very honest with you, that most of the stuff that I've used throughout my career to figure out what the right multiple for the stock market, you could essentially just throw out the window over the past couple of years, right? Because, so for a while, when I first got into the business, and this was actually a pretty reliable thing, you could use the rule of 20 take 20 minus the inflation rate is actually a pretty good, over long periods of time, that was about right what the PE traded at. But that, of course, would give you something like 18 times earnings. I do an econometric model that uses interest rates, inflation, and taxes on dividends and capital gains. That gives me something like 21 times earnings. Then the Fed model, of course, would give you something like 60 times earnings. Right? You put a bond PE on the stock market. All those seem awfully high to me. I mean, I think that it's probably, I guess I'm getting into the idea that it's more, at this amount of incursion by policymakers into the markets, it's hard to use the old metrics. One of the and this argues again for one of the reasons why what the Fed is doing can be dangerous, and I understand why they're doing it. But the other, I saw the Boeing plant on the way here yesterday, and I was thinking, like, I mean, it would be like, the problem with the Fed buying so many of the treasuries, it's like you're taking a part of the cockpit or the altimeter and you're just throwing it out the window for policymakers, right? So for the president and Congress, you're not getting an important signal about, when it's time to stop drinking, right? You're like, let's go for it. And President Clinton, I remember in '94, he wasn't particularly happy about the fact that the bond market had kind of the ultimate say on how much he was spending. But it wound up being the best thing that ever happened to the guy, really, in a way. And right now, the thing, the gentleman's point before, one of the problems is, you can, without really mending your ways, you could get in deeper trouble. And so it's a long-winded way of saying it's with policy so involved in what's going on a day-to-day basis in the economy, it's harder to get, to place the full multiple that you would in a normal environment. I think it should be somewhere between probably should be somewhere between 16 and 18, it seems to me. You'd have to take a little bit off the number just because probably central tendency for 10-year Treasury is probably about 4%. Usually 10-year Treasuries trade about where nominal GDP growth is. It's about 4 now. But, well, thank you very much. I hope this was helpful. And please let us know if we can be of any help. Chris and I thank you for your time today. Thank you.